Hi, I'm David Auerbach. I'm the Managing Director of Armada ETF Advisors, and we're here for another C-suite interview. Today, I'm here joined by Sam Landy. He's the CEO of UMH Properties. For those that don't know, UMH, publicly headquartered here in Freehold, New Jersey. From their last update, now they did just report earnings, and we're going to hear about some of the changes to these numbers, but they did own 131 communities with about 25,000 home sites in 10 states such as New Jersey, New York, Ohio, Pennsylvania, Tennessee, Indiana, Maryland, Michigan, Alabama, and South Carolina. They've also got a joint ownership venture in Florida with 219 sites. Plus, they own a bunch of land across the country, 1,800 acres for the development of new sites. UMH is a very unique manufactured housing REIT. We're going to spend some time going in today about the portfolio, the capital allocation for the company, as well as learn more about Sam and his family's history at UMH. So, Sam, thanks so much for joining us today.
It's my pleasure to be here.
Awesome. So let's kick it off. Tell us about UMH, the types of properties, the markets you're invested in. Let's talk about maybe the Marcellus and Utica Shale region, why you're developing, and basically the why of manufactured housing.
So I'll begin with UMH has a great website at umh.com where people can follow along with this interview. There's investor presentations, and you could see maps of the property, pictures of the homes, videos of the communities, which will give you an even better understanding of my answers. UMH has been in manufactured housing for 53 years. People need quality, affordable housing. We've picked geographic areas that need workforce housing. So the history of the company was, New Jersey, Pennsylvania, Ohio, and that's where the coal, steel, tire jobs were. And, communities historically did very well. If you looked at 1960s, 70s, 80s, 90s, most manufactured home communities were over 95% occupied. People, whether they were manufacturers, dealers of homes, finance companies, or community owners, did very well. Demand for affordable housing is usually incredibly strong. My father, Eugene Landy, founded the company back in 1968 because he understood the need for quality, affordable housing. He went to a World's Fair. He saw manufactured homes. He said, this is the answer. Factory-built housing makes sense. It costs about 30% less per square foot to build in a factory than build on site. Today, we look at, ESG, also environmental, social governance, and building in a factory reduces your waste, more energy efficient, but monetarily, it's also more efficient. So we went into this business of, manufactured homes in communities. There used to be a network of dealers selling homes, putting them in your property, and you were managing the community for people who brought you houses. And the business fundamentally changed about 2002, and you can trace that to NAFTA. Some people do, some people don't. But as our country lost its workforce jobs, as there was a giant demographic shift out of Pennsylvania, Ohio, steel factories closed, tires, coal plants closed, and those jobs were lost, and those people had to permanently relocate. So the loans on manufactured homes at that time went bad. Green Tree turned into Conseco, filed bankruptcy. We lost many manufacturers, Oakwood Homes. There were bankruptcy on the manufacturer side. And we lost the distribution network of retailers who were providing and putting homes in communities. UMH solved all of those problems. We experienced the problems, but we solved them. The first problem was lack of financing about 2002 for our retail customers. So we decided we could finance homes. And that worked phenomenally well. We realized and understood the other finance companies had the ability to put money out, but they didn't have the ability to manage defaulted collateral. And we looked at our individual community managers, our attorneys, our maintenance staff, and figured out that, look, if we lend somebody money to buy a home and they can't pay, it's very easy for us to take back the home, winterize it, properly price it, resell or rent it. And that was our business model from 2002 to 2009, and it was very successful. But in 2008, approximately 2007, 2008, as a result of the home mortgage crisis, when all of home building stopped and there were massive defaults on conventional mortgages and the whole housing industry really collapsed, the government, looked to solve the problem by creating stronger lending standards, and they included manufactured housing. Barney Frank said that Dodd-Frank and the SAFE Act was never meant to include manufactured housing, but in fact we were included, and that meant that all of our salespeople either had to be a mortgage loan originator or could not discuss monthly payment. That was basically devastating to the industry, because how can somebody sell a product, affordable housing, that's based on monthly payment without discussing monthly payment? So 2007 to 2011, the industry suffered greatly. Shipments fell from 300,000 in the 1970s to 40,000 shipments in 2009. But UMH figured out in about 2011, Sun discovered it before us, but rental homes were the solution. Just go to rentals. If you couldn't qualify your buyer, if you couldn't discuss monthly payment with your buyer, you could rent to them if you believed in them. And that was the reason we had our success 2002 to 2009. We believed in our customer. We understood if somebody was being foreclosed from a $300,000 house, that would destroy their credit. But if they had income, if 30% of their income would cover the lot rent and finance payment, then we could ignore their bad credit. They were going from a $300,000 house to a $70,000 house. Their payment was falling from $3,000 a month to $800 a month. So it didn't make sense to turn them down just because of bad credit. Sell them the house and let them live with the lower payment. And we did that time and time again from 2002 to 2008, resulting in successful expansions, resulting in about 2006, we were less than 1/4 the size we are today, and we sold $16 million worth of houses, made $2 million in sales profits, filled 260 lot expansions, and just the company kept doing well because of our belief in our customer and our belief in our team to make those decisions and finance those houses. 2009, the government changed all the laws. We couldn't use our own judgment to finance homes anymore, and that seriously negatively impacted us and everybody in the industry through 2011. And then, as mentioned, we went to rental homes, and we started out renting 100 homes in a year. Then we went to 300 in a year, then 500, then 800 a year, so that we now have approximately 8,800 rentals. And we've been gearing ourselves so that by building expansions, buying communities with 70% occupancy or even 30% occupancy, we have the vacant lots in place to add 900 rental homes per year for the next 5 years. So that, and longer, but certainly for the next 5 years. So that's 4,500 homes that in today's dollars will rent for about $10,000 per year rent, about 900 a month, maybe 1,000 a month. But anyhow, you could do the math and figure out if we add 4,500 units at $10,000 per year per unit, it's another $45 million in revenue. And then you look at what do these homes cost, and it's very variable. You could use a $70,000 house, you could use a $100,000 house, and then what's the lot cost? And we obtain lots as little as $23,000 in Dothan, Alabama, and Sumter, South Carolina, and we build lots for about $100,000. So if you take the most extreme cost, a $100,000 lot with a $100,000 house, we provide 1,000 square foot, 3-bedroom, 2-bath, energy efficient house on a 50 by 100 lot. So you have your own yard, you have your own driveway, you have your own shed, no common wall neighbor above, below, beside you. It's a place people want to live, and it's somewhere around between $800, $1,200 per month. The reason I say 800 because on those lots that we get for $27,000 and add a $70,000 house, the whole unit costs $100,000. So for that whole dwelling unit for $100,000, we could charge $800 per month. And when the whole dwelling unit costs $200,000, we might be $1,100, $1,200 a month. We're even getting $1,700 per month on our new community being built in Sebring, Florida. So the product is, desired by people who need quality, affordable housing. Going to rentals solved a number of problems. One, the lack of financing. Two, the friction that's involved in a transaction when somebody buys a home. So let's say you're a young person who thinks of yourself as I'm only going to be at this job and this place for 1 to 3 years, and then I'm moving up. Well, by not buying the house, you're not locking yourself into the difficulty of selling it, tying up your capital. They just need 1 month rent and 1 month security. So $1,600, they have to qualify. So 30% of their income has to pay $800 per month. So that's, $10,000 per year on just $30,000 household income. They can qualify. And if they have bad credit on rentals, we can stick to our old standard of, can you explain why your credit's bad? Generally we wouldn't rent to somebody who's not paying, their phone bill, their cable bill, et cetera. They have a history of just non-payment. But to somebody who, wound up with a crisis due to medical bills, divorce, job loss, foreclosed out of an expensive house, those are all reasons we can understand and say, okay, your income means you can easily afford this. You couldn't previously afford your past situation, but you can afford this situation. And, if we see that you're paying your small bills that you can afford, then we know you're going to pay your rent to us too. And so we could accept them despite poor credit. And that's what we've done. And it's occupied, 8,800 rentals. And it means that the future is extremely bright for UMH because people want our product. Real estate's all location, which gets to an interesting little story that yesterday I saw a modular home in any other town. This house would sell for $450,000. It was in Rumson, New Jersey. In Rumson, New Jersey, it's $1.2 million. So location is everything. And we've picked very good locations that have strong workforce housing demand.
That's really interesting. Thank you for that. This year, UMH did something that I don't recall seeing any other REIT do in our industry, and you guys dual listed in Tel Aviv. Can you talk to the benefits for U.S. investors for the cross listing? Maybe talk about the opportunity to raise additional capital overseas or debt issuance, maybe JV capital. Why Israel? Can we go through that?
Well, first, foreign investors in all countries want the security of the U.S. capital markets and U.S. real estate. Pick the country and think of how inflation devastates the value of their currency, how political instability causes a need for secure investment in a politically stable situation. Israel happens to have low inflation and a politically stable country. But even so, people are becoming wealthy in Israel through technology, through real estate, through other things, but they want geographic diversity. They'd like to be in U.S. real estate. And UMH has a great story, and we have a history in Israel, dating back many, many decades. My father first visited Israel as a merchant marine in 1953 and was visited by my cousin at the ports as he arrived. So we have a very long-term history with Israel. And when we went to the U.S. capital markets we knew we were going to redeem the preferred stock this year that we just redeemed in July. It was $257 million at 6 3/4. So we were trying to redeem that at the lowest cost possible. So we approached the U.S. banks about what can we do a preferred issue for, and they were quoting us in the sixes. And, we looked for unsecured, secured debt. But Israel had an incredible system, Leader Financial, Michel Naveau, and they explained to us how the institutions, which include $100 billion insurance companies, would bid rate based on how many dollars worth of the unsecured bond they would want. And they sent us to a rating agency first. So UMH was able to get an overseas rating of AA- on the issue and A+ for the company. So we were able to get those ratings in Israel before we did the issue, so that when we're discussing with the insurance company, should you invest in this, we have a rating. Additionally, overseas accounting, as opposed to U.S. accounting, factors in appreciation. In the U.S. under GAAP accounting, we have depreciation. So, if your property is making $1 million, but you're depreciating $1 million per year based on, the IRS accounting rules, it shows up you're making no money. But in Israel, they look at, well, what's the value of the property doing? And if, UMH has $2 billion in assets, and if 500 million is rental homes and $1.5 billion in real estate, and by the way, the rental homes are appreciating, but even if you want to take that out of there and look at $1.5 billion and say it goes up in value 4%, that's $60 million per year. Well, the U.S. doesn't look at that in accounting. I mean, we can explain to people that real estate appreciates and that you should look at internal rate of return and that real estate is not just funds from operation, but not everybody rapidly understands that. In foreign accounting, they rapidly understand that because their accounting includes bookkeeping for appreciation. So Israel understood that, not only do we have funds from operation, not only do we have the opportunity to redeem the 6 3/4 preferred with lower cost capital, which obviously will be immediately accretive, but these properties, our vacant land, our existing communities, they go up in value every year, and that should be part of the equation. So they took us, it was virtual, but it was quite a roadshow. We had to get up every morning. I think we started at 6:30 in the morning, and we had to get up earlier than that. And then virtually for something like 6 days, they had meetings all day with, many, many, many different institutions, and the institutions bid it. And I think we came to 4.72, 4.27. 1.62. Okay. You guys can edit that. We'll get it right.
Yeah, we are joined with other members of management off screen here that you can't see.
That are helping me. Whichever the exact rate was, 4.62, 4.72. So, okay. 4.72. So we did the $100 million and it's slightly plus of $100 million at 4.72. And that's one of our sources of capital to redeem the preferred. The other was our common ATM. And, additionally, we pioneered the financing with Fannie Mae where they accepted rental homes in the community so that we borrowed $100 million at 2.62 and then did a later issue, financed $25 million directly by the rental homes for, I think, 4.25 or whatever the exact number was, somewhere right in there. But anyhow, it all averages out and becomes very accretive to redeeming the 6 3/4 preferred, which only happened July 26th of 2022. So, and then we went back to Israel. We did the preferred, we did the unsecured debt online by virtual, but then we traveled to Israel and did a roadshow just this past June where we met directly with the investors to talk about our success so that, they'd be interested in a later unsecured debt issue, but also to interest them in the common stock. We're listed on the Tel Aviv Stock Exchange. We have an ATM. It's good for all our shareholders if there's increased demand for the stock. And the Israelis are very interested and understand the story. But Bernberg is also one of our investment banks, which gives you, vast international ties to many countries, and we believe we will continue these international relations and international roadshows because, worldwide people are looking for secure yield, which is what UMH provides.
Well, you have mentioned about the redemption of the Series C, and you've kind of hinted that the Series D will most likely be redeemed probably into 23 as well, if we could forecast out a little bit. How do you think about balancing short-term versus long-term capital allocation decisions? Is there maybe some discussion here for you guys about maybe utilizing marketable securities book to help fund that redemption? Or do you think, as you basically have stated, that maybe Tel Aviv will help you take out the Series D as well?
So capital allocation is extremely complicated. We made a ton of money with 8 1/4 and 8% preferred buying properties that yielded 6. And everything is a question of what can you do with the capital? Can you outperform your cost of capital? And UMH has historically been able to do that. And so at this moment, we're building expansions, we're buying rental homes, we're doing acquisitions. and capital costs are rising. Since we did the Israel unsecured debt, interest rates have increased quite a bit.
I mean, even just go back 6 months, a year prior to that, go back to COVID when we were at a 1.5, 10-year treasury world. I mean, again, that was like the unicorn for a lot of the folks in the industry, right? So, you were able to take advantage of that ripe capital conditions at that time as well.
Correct. And now I happen to believe, it doesn't mean I'm going to be right, that this is all relatively short term. What happened is COVID stopped production, right? So what is inflation? Inflation is too much money chasing too few goods. There's too few goods because nobody could produce goods for an entire year during COVID. So, the Federal Reserve and many people are blaming the problem on too much money. And higher interest rates is the solution to too much money. It reduces the money supply. But isn't a better solution to increase the amount of goods? And unfortunately, increased interest rates actually reduce production because it costs more and it's more challenging to raise capital to produce goods. So between increased energy prices, increased interest rates, I have no question they're going to slow down the economy. I believe it was Milton Friedman who said the Federal Reserve has a very powerful brake. They can stop the economy dead and send it all through the windshield, but they have a weak gas pedal. They can lower interest rates, but they really can't accelerate the economy. So I think they've hit the brakes pretty hard, and we're going to feel that, at some point in time in the near future, at which time the next step is reduce rates. And, the country, the national debt, that's very expensive to finance. So the country wants low-cost interest rates. So I think you're going to have this short-term dramatic increase in interest rates with long-term low interest rates. And so, thinking about UMH in the short term, we may not immediately retire the 6 3/8 preferred. We may or we may not, but rates are declining. But rates are currently increased to decline later. But we have deals pending that would be accretive even with 6 3/8 money. And so we have to, give that a lot of consideration. A lot of what we do and a lot of the reason for our 53-year successful history is we recognize the importance of keeping the tank full of gas. And that's having money in your pocket. And that's the REIT portfolio too. That's $50 million that people can criticize. It goes up and down in value. The dividend got cut. Whatever they want to say, it was extremely successful for a number of years in terms of the profit it earned on dividends and appreciation and realized gains. But however you want to look at it, it's $50 million immediately available liquid in our pocket. And there is an incredible value to that, which gets you through every cycle. And it's not just that the money's there to get you through the cycle, it's your banker knows the money's there. And that gets you lower interest rates, et cetera, which also goes to UMH's philosophy of only raising rates 4%, raising rents 4%, not higher, because our good relationship with our residents creates a good relationship with government-sponsored entities, which means when Fannie Mae and Freddie Mac are considering lending to us, they're in favor of it. We're not the bad guy operator who Fannie Mae is receiving political pressure not to lend to. We're on good terms. And so there's a great value to being constrained on rent increases and considering our existing residents our partners, and that our relationship with them is not charge them the maximum we can at every given moment. Our relationship with them is help their homes to appreciate, let them know that they made the right housing choice, let them know we're on their side, and that benefits us, just like we may decide to continue to pay 6 3/8 on the other preferred, because in the short term, that money's going to help us to grow.
And as somebody who's been an institutional trader for many years, I can tell you that there are a lot of sad people when UMHC went away, and there will be even many sad people when the Ds go away. It is a very popular institutional holding name for the preferred players. Let's talk about the common stock, though. Commons trading around 20 and change as of yesterday's close. For purposes, today is Friday, August 5th, 2022. Looking at the Bloomberg this week, I saw 7 buys, 1 hold. So the street obviously likes the story here. But what do you think, just high level, maybe analysts are missing about the company?
I think our analysts are wonderful and nobody's missing anything. But what I would say is this. If you're competing with other people to buy real estate or stock, everybody's time horizon is incredibly short. So competing against those people on the same time horizon is incredibly difficult. But if you create a 5-year time horizon for yourself, nobody else is even looking at that world. So my recommendation is go to a 5-year time horizon. And what do you know about UMH? We have $167 million in rental revenue, and we're going to raise rents 4% a year for the next 5 years, and there's no reason to believe we won't get that. So, that's roughly $8 million for 5 years. So we're going to be ahead more than $40 million in revenue over 5 years from the rent increase. We believe we can add 900 rental homes per year for 5 years. That's 4,500 more rental homes that are going to rent for at least $10,000 a year. So put another $45 million right there. We are going to continue to increase our home sales so that by the 5th year, I don't think it would be unrealistic to say we're making, let's put $6 million on sales at that point in time. And then our finance income continues to grow. And we're building expansions. We're building 400 lots, that's correct. 400 lots per year for the next 5 years. So put another 2,000 lots and lot rents closer to $6,000 a year. So put another $12 million there. So in 5 years, we're going to grow revenue over $100 million. So when you look at that $100 million and then you factor in our expense ratios better than 50%, so 50% gets to the bottom line, and you look at we're reducing our cost of capital, and you figure those rental units even at $100,000 each, and you look at what that costs, and you look at what our cost of capital will be at that point in time, but you'll come to the conclusion that UMH could potentially double funds from operation over 5 years, and doubling FFO potentially, I'm making forward-looking statements, means you could potentially double the dividend, which means you could potentially double the stock price. None of that's certainty. That's all future-looking statements, and anything in the world can happen. But if you do the math, there's no reason not to put that as a UMH goal and think it's achievable.
When you, off the script here, but as you go in towards that 5-year plan, would you say, let's say, again, I know we're looking forward-looking, but after year 1, hey man, we're 20% of the way going where we said we're going to be in 5 years. Year 2, we're 2 years into this. We're on track. Do you plan on communicating with the investment public? We're on track. We're on this path. We're standing by this.
Well, not only is that true, but if you take our annual report and look back 5 years, that's what's occurred. So there's no reason to believe it won't occur 5 years in the future.
We're going to be back here August 5th, 2027. Go ahead and put it on the calendar there, Jim. We're going to revisit this and see if we're at the same spot.